Right now, as you're listening to this, there is a country where 1 in every 30 adults just got margin called. And to be clear, that is not 1 in 30 investors. That is 1 in 30 adults, the general population. Over 1 million accounts, all leveraged, all betting on the exact same handful of stocks, all wiped out in the space of a few weeks. Hundreds of thousands of retail accounts, forcibly liquidated, basically overnight. And the wild part is, that is not 2008. That is South Korea this July, happening right now, right in front of us. Here's the thing nobody really wants to say out loud. The blueprint for this entire collapse is sitting on a shelf in a book almost everyone already owns, Michael Lewis's The Big Short Inside the Doomsday Machine, written almost 20 years ago, about a completely different country, a totally different asset class, and it still predicts exactly what just happened in Seoul, line for line. Same leverage, same crowd chasing the same trade, same regulators showing up only after the bodies hit the floor. Because the underlying architecture of a financial panic rarely changes, you can swap out American subprime mortgages for South Korean AI memory chips, and the human vulnerability, the psychology, the structural blind spots are nearly identical. So no, this is not a history lesson about mortgages. It's a description of a machine that never actually got dismantled. It just changed its name and moved to a new address. If you've ever felt like the only person in the room still doing the math while everyone else rides the wave, this one's for you, because today I'm dissecting mass hysteria, and more importantly, the mechanics that let that hysteria get weaponized into financial products complicated enough that even the people selling them barely understood what they'd built. I want to start with something almost nobody mentions when they cover this book. People talk about Michael Lewis like he's just a great journalist who stumbled onto a juicy story. He is a great journalist, but he did not show up as an outsider. He used to work inside the exact same machine. Back in the 1980s, he was a bond salesman at Salomon Brothers, the firm that basically invented the mortgage bond as a trading instrument in the first place. He wrote an entire book about that culture, called Liar's Poker. And that background is the skeleton key to everything in The Big Short, because Salomon Brothers took ordinary, boring 30-year home loans, the kind your grandparents had, the kind that just sat in a local bank vault for 30 years gathering dust, and figured out how to bundle thousands of them together, securitize them, and trade them like casino chips. When he wrote Liar's Poker, Lewis thought he was documenting a bizarre, unsustainable moment in financial history, a message in a bottle about 1980s greed. He thought it was a period piece. So when he comes back decades later to write about the 2008 crisis, he's not some tourist taking notes. He's a guy walking back into his old house and finding out that the thing he watched get built in the basement ate the whole building, Frankenstein's monster, except this one made partner. Because Lewis was actually in the lab, his lens is completely different from a standard financial journalist. Most reporters approach Wall Street assuming the system is basically rational, that the complex math is there for a legitimate economic purpose. Lewis approaches it with the baseline assumption that the complexity is a smokescreen, and that is why the book has teeth. He's not intimidated by the jargon, because he used to speak it for a living. When a banker says residential mortgage-backed security or collateralized debt obligation, Lewis just rolls his eyes. He knows exactly what that language is designed to do, which is keep you confused enough to stop asking questions. So, here's the obvious follow-up. If the language is intentionally built to keep people out, how did anyone actually see through it? Because everyone already knows the headline. The doctor turned hedge fund manager who sees the crash coming before anyone else. Michael Burry. What most summaries skip is why he was built to see it. And honestly, why almost nobody would listen to him even after he turned out to be right. You have to look at his background. As a kid, Burry lost an eye to cancer and had to get a glass eye, which profoundly changed how he moved through social situations for the rest of his life. Later on, he came to believe he had a mild form of Asperger's, though it was self-diagnosed. Here's what that meant for him as an investor. He wasn't reading the room, he was reading the document. And that distinction matters, because Wall Street is fundamentally a social club. Traders talk to brokers, analysts go to conferences, portfolio managers are out playing golf, all of them constantly gauging the mood of the herd. Burry was completely immune to that. While every other trader on Wall Street was reading each other's moods, he was locked in an office in San Jose, alone with his computer, actually opening mortgage bond prospectuses and reading the loan tapes line by line. And people underestimate what that actually entails. When you hear reading a prospectus, you probably picture skimming a glossy brochure. Not even close. A mortgage bond prospectus from the mid-2000s is a dense, intentionally opaque legal document, hundreds of pages long, listing thousands of individual mortgages bundled into a single security. To actually understand the risk, you have to dig into the credit scores of the individual borrowers, the loan-to-value ratios, and the structure of the interest rates buried in the fine print. Nobody else was doing that. Not because the math was hard, but because it was boring. And boring things do not get read when everyone around you is getting rich the easy way. People forget he built his early reputation writing investment analysis on an online forum late at night after his day job as a doctor. That's the part that never makes the highlight reel. This guy was a neurology resident at Stanford Hospital. 16-hour shifts, grueling patient rounds, the kind of exhaustion that flattens most people. And he's up from midnight to 3 in the morning, typing for free into a message board, because he could not stop himself from doing the arithmetic everyone else had given up on, an outlier in the truest sense. Not because he had some superhuman intelligence, but because he was willing to sit through the crushing boredom of actually checking the numbers. And that boring, unglamorous work is exactly how he spots the structural flaw that eventually brings down the global economy. He discovers that the majority of subprime loans are what's called 228 adjustable rate mortgages. Let's actually break that down because it's crucial, and most summaries just gloss right past it. A 228 ARM means the borrower gets a fixed, artificially low teaser interest rate for the first 2 years. That's the 2 in 228. Say you take out a $300,000 mortgage. For the first 2 years, your rate is locked in at maybe 2%, so your monthly payment sits around $1,100. Totally manageable. But after those 24 months, the rate resets. It jumps to a floating market rate plus a heavy premium, so overnight your interest rate jumps to 8 or 9%. That $1,100 payment turns into something closer to $2,400. And remember, these loans were being marketed hardest to subprime borrowers, people with spotty credit, low incomes, or in a lot of cases, no documented income at all. The now infamous ninja loans. No income, no job, no assets, and somehow still, a mortgage. Burry runs the math and realizes the borrowers mathematically cannot afford the reset rate. They are functionally bankrupt the moment they sign the contract. It just has a 2-year delay built into the paperwork, a ticking time bomb sold to people who had no idea they were holding one. But spotting the bomb is only half the battle. If you know an explosion is coming, how do you actually bet on it? You need a financial instrument that pays out when those specific mortgages fail, which brings us to a piece almost every summary gets wrong, usually by leaving it out entirely. People talk about credit default swaps like they were invented by some cabal of evil Wall Street masterminds specifically to cause the 2008 crisis. They weren't. They were built years earlier, in the 1990s, for a completely boring, completely legitimate reason, pioneered by a team at JP Morgan. Picture it. A major bank loans $1 billion to a company like General Electric. The bank's risk department gets nervous about holding that much exposure to one single company. They want to offload the risk, but they can't just sell the loan to another bank because that damages the relationship with General Electric, and General Electric would not be thrilled. So instead, the bank goes to an insurance company like AIG and says, "We'll pay you a quarterly premium, and in exchange, if General Electric defaults on this $1 billion loan, you make us whole." That's a perfectly reasonable tool solving a reasonable problem. It works exactly like standard insurance. You own the asset, so you insure the asset. Here's where it mutates into something else entirely. That same tool got repurposed to let you bet against something you never owned in the first place. You didn't need to hold the mortgage bond to buy insurance on it. You just needed a bank willing to take the other side of the wager. In the traditional insurance world, that would be flatly illegal. You cannot buy fire insurance on your neighbor's house because the moment you do, you now have a very strong financial incentive to sneak over at midnight with a match. It creates an enormous moral hazard. And yet Wall Street regulators permitted exactly this structure in the bond market. It was called a naked credit default swap. You could buy insurance on a bond you had zero economic interest in, which means, for the first time, you could build a position worth billions of dollars against a stack of mortgages worth only a fraction of that. The tool itself was never the problem. The casino built on top of it was. The asymmetry here is worth sitting with because it explains exactly why Burry went all in. The downside on a naked credit default swap is capped. You just pay the insurance premium, roughly 1.5% to 2% of the position each year. But the upside is spectacular. Put down $2 million a year in premiums on $100 million of naked credit default swaps. And if those mortgages default, the bank on the other side owes you the full $100 million, a 50-to-1 payout. It's basically walking up to a roulette table, putting down $2, and the dealer telling you that if it lands on black, they'll hand you $100. And Burry, because he actually read the loan tapes, knows the wheel is painted entirely black. He just has to wait for it to stop spinning. But if the math is that obvious, somebody out there is still willingly taking the other side of the bet. Who's playing the dealer, happily pocketing Burry's premiums while ignoring the risk sitting right in front of them? An entire ecosystem of collateralized debt obligation managers, and the book leans on one name in particular to illustrate exactly how broken those incentives were. Wing Chow. He managed collateralized debt obligations, or CDOs, another piece of jargon worth demystifying. Think of a CDO as a big box that Wall Street crammed full of different mortgage bonds, then sliced into layers of risk called tranches. The top layer gets paid first, so it's rated AAA, supposedly as safe as a US Treasury bond. The bottom layer, the equity tranche, gets paid last and absorbs the first losses. And Wing Chau's job, as the manager, was to select which mortgage bonds actually went into the box in the first place. So really, he's the guy picking the ingredients for the sausage. But you have to look at how he was compensated, because that's where the whole thing rots from the inside. He wasn't paid based on the long-term performance of the loans he selected. He was paid a flat fee based on the total volume of assets he managed, which makes him less a portfolio manager and more a fee extraction machine wearing a portfolio manager's suit. The more collateralized debt obligations he created, the more money he made. The actual quality of the mortgages inside the box was completely irrelevant to his personal bottom line, because if he stopped buying bad mortgages, his assembly line shut down, and so did his multi-million-dollar paychecks. This is where Steve Eisman enters the story, the loud, perpetually furious hedge fund manager who shows up throughout the book. Eisman figures out this twisted incentive structure by going straight to the source at a securitization conference in Las Vegas, of all places. There's an incredible moment where Eisman is sitting in the audience listening to the chief executive of a subprime lender called Option 1. The man is up on stage projecting total confidence, claiming they only expect a modest 5% loss rate on their subprime loan portfolio. Eisman doesn't even bother asking a question. He just holds up his hand and makes a 0 with his thumb and index finger. 0, meaning 0% of what you just said is true. Because Eisman had realized the subprime lenders on the ground, the people writing loans out of strip malls across America, were effectively fish farms for Wall Street's collateralized debt obligation machine. They didn't care whether the borrower could actually repay the loan because the lender wasn't keeping the loan. They were selling it off to Wall Street within days, and Wall Street had an insatiable appetite for mortgages to package into these products because the fees were that lucrative. When you have infinite demand chasing a finite supply, in this case creditworthy home buyers, the only way to keep the machine running is to degrade your standards. You start lending to people with lower credit scores, then you stop verifying income. Then you start handing out loans with no money down at all. So the system did not accidentally fail to notice the bad mortgages. It actively demanded them. The whole setup was engineered to reward blindness. If a manager's year-end bonus depends on not understanding the underlying risk, that manager is going to become a world-class expert at not understanding the risk. Which brings us to the single most destructive innovation in modern financial history, the mechanism that turned a localized American housing problem into a global catastrophe. The synthetic collateralized debt obligation. I want to spend real time here because this is the exact bridge between the 2008 mortgage crisis and the 2026 South Korean AI crash. It's the connective tissue between the two. In 2008, there was a natural ceiling on actual physical bad mortgages. There are only so many houses in Florida and Nevada, and only so many subprime borrowers to sign the paperwork. In a sane system, the losses would have been capped by the total value of those bad loans, but a synthetic collateralized debt obligation fundamentally alters the physics of the market. A traditional one is a box full of actual mortgage bonds. A synthetic one doesn't contain a single actual mortgage. It's a box full of credit default swaps, a box full of the side bets placed on the mortgages. Picture a football stadium. On the field, there are players, and the players represent the actual physical mortgages. If a player fumbles the ball, that's a mortgage defaulting. The total money at risk on the field is just the salaries of the players. Call it $50 million. But up in the stands, there are 100,000 fans, and they're taking bets with each other on whether the players will fumble. They're betting billions of dollars on a game with only $50 million of actual economic value happening on the field. That's the credit default swap market. The fans don't own the players. They're just betting on the outcome. The synthetic collateralized debt obligation takes it one step further. Wall Street banks took the betting slips from the fans in the stands, bundled those betting slips into a brand new box, slapped a AAA rating on it, and sold that box to, say, a pension fund in Germany. They synthesized an entirely new asset out of pure speculation. So when one player fumbles on the field, it doesn't just impact the team. It triggers a cascade of payouts up in the stands, which then triggers the collapse of all these synthetic boxes sitting on bank balance sheets around the world. Because Wall Street allowed 50 side bets to stack on top of a single underlying mortgage, they took what was roughly a $1 trillion subprime mortgage problem and magnified it into something closer to a $50 trillion global bomb. And this exact multiplier effect, this illusion of liquidity created by synthetic leverage, is what we are watching detonate in real time in South Korea. Right now, as I'm recording this, the asset has changed from American subprime housing to South Korean AI memory chips, but the structural doom loop is identical. So let's lay the groundwork. What exactly is a leveraged exchange traded fund? An exchange-traded fund, or ETF, is simply a basket of stocks you can trade like a single share. A normal one tracks an index like the S&P 500, or in South Korea's case, the Kospi. If the index goes up 1%, the fund goes up 1%. Simple. But a leveraged ETF uses financial derivatives to amplify that return. A 3 times leveraged ETF aims to deliver 3 times the daily return of the index. If the Kospi goes up 1%, the fund goes up 3%, which sounds fantastic on a Tuesday when the market is rallying, but dig into how they actually achieve that multiplier, because they aren't just buying stocks with cash. They're using swaps and margin debt. And the flaw that turns these funds into weapons of mass destruction during a downturn is the requirement for daily rebalancing. To maintain a constant 3 times leverage ratio, fund managers are mathematically forced to buy or sell assets at the end of every single trading day, regardless of price. Let's walk through a hypothetical, because this is exactly where retail investors get slaughtered. Imagine a benchmark index sitting at $100, and you buy a 3 times leveraged ETF tracking it, also starting at $100. Day 1, the market gets spooked, and the index drops 10%, down to $90. Your 3 times leveraged ETF drops 30%, down to $70. Painful, but you're holding on. Here's where the mechanics take over. At the end of day 1, the fund has lost 30% of its value, and to maintain its 3 times leverage target for the next day, it's mathematically forced to shed exposure, selling off millions of dollars in underlying assets at the exact moment those assets have dropped in value. That's the opposite of buy low, sell high. The fund is structurally mandated to sell low, a mechanical, forced liquidation built into the product itself. Day 2, the index bounces back, up 11.1%, back from $90 to the original $100. The index has fully recovered. Since your fund is 3 times leveraged, and the index went up 11.1%, your fund should go up 33.3% that day. Your fund, which ended yesterday at $70, goes up 33.3%. But 33.3% of $70 is only $23.31. So your fund ends day 2 at $93.31. The index fully recovered to $100, and your 3 times leveraged fund is still down almost 7%. That's called beta slippage, or volatility decay. The math of daily compounding means that in a volatile market, a leveraged fund structurally bleeds value even if the underlying asset ends up completely flat over time. And it gets worse once you add concentration risk. This is the South Korean blind spot. Over the past 18 months, South Korean retail investors poured billions of won into these 2 and 3 times leveraged ETFs, but these funds weren't tracking a broad, diversified index of hundreds of companies. They were essentially tracking 2 stocks, Samsung Electronics and SK Hynix, because those 2 companies dominate the global supply of high-bandwidth memory chips critical to artificial intelligence. And because of their size, they make up roughly half of the entire Kospi index's market capitalization. So when 1 million retail traders bought a 3 times leveraged Kospi ETF, they were really taking a massively leveraged bet on exactly 2 companies. Here's what happens when those 2 stocks take a hit. You trigger the doom loop. A bad earnings report comes out. Samsung's stock drops. The 3 times leveraged ETFs take a massive hit. And as established, at the end of the day, those funds are mathematically forced to sell underlying shares to rebalance their leverage. So the ETFs dump massive blocks of Samsung stock onto the open market, which pushes the price even lower, which means the next day the ETFs are forced to sell even more shares to rebalance again. The derivative product starts wagging the dog. Forced selling from the leveraged ETFs actually dictates the price of the underlying stock, turning a standard market correction into an uncontrollable cascade. It's the stadium analogy all over again, except now the fans in the stands are physically shoving the players around on the field. And this isn't theoretical. There's real data on it. The 3 times leveraged Kospi fund, ticker KORU, plummeted 70% from its all-time high between June and July. 70% wiped out in weeks, and the underlying stocks didn't drop 70%. It was the synthetic leverage stacked on top of them that accelerated the destruction, because the vulnerability in both 2008 and 2026 is the same illusion of liquidity. In the housing crisis, collateralized debt obligation managers assumed they could always find a buyer for their AAA-rated bonds. In South Korea, retail traders assumed they could just open an app and tap sell whenever they wanted out. But when the underlying asset is that concentrated and the leverage is that extreme, the exit door shrinks down to the size of a keyhole, right at the exact moment the whole theater catches fire. Which raises an obvious question. If the mechanics of this doom loop are so deeply embedded in the math, where were the referees? If the exit door is that small, why did anyone let 1 million people into the theater in the first place? Let's start with the compromised umpires of 2008, because the book pulls no punches here. The referees were the credit rating agencies, organizations like Moody's and Standard & Poor's, whose entire mandate, the sole reason they exist, is to objectively grade the risk of a bond. Extremely safe. AAA. Risky. A lower grade. Institutional investors, like pension funds for teachers and firefighters, are legally required by their own bylaws to only buy AAA-rated bonds, which means the rating agencies hold the keys to the entire global capital market. If they don't stamp AAA on it, the pension funds can't buy it, and the Wall Street collateralized debt obligation machine grinds to a halt. So why on earth were they stamping AAA on boxes full of toxic defaulting subprime mortgages? Because the fundamental flaw was baked into their revenue model. These were private companies, paid by the exact same Wall Street banks whose bonds they were grading. It's genuinely hard to overstate how absurd that is. It's the equivalent of a student paying their professor $100,000 to grade their own final exam, and if the professor grades too harshly and hands them a C, the student simply walks the money down the hall to the professor who guarantees an A instead. Wall Street banks explicitly shopped around for the best rating. If Moody's tried to tighten its risk models, the banks would just threaten to take all their lucrative securitization business to Standard & Poor's. It was a race to the bottom, and the rating agencies rubber-stamped garbage as gold, because if they didn't, they'd lose market share. Their profits depended on staying willfully blind. Now, look impartially at the regulatory environment in South Korea in 2026, and you find a different flavor of institutional failure. Not necessarily a direct conflict of interest like the rating agencies had, but a profoundly reactive, sluggish bureaucracy. Here's the timeline, just the raw facts. The Kospi index fell roughly 27% from its June peak, crossing officially into bear market territory. Hundreds of billions of won in retail wealth were vaporized. And it was only after that massive wealth destruction, only after the forced liquidations had already torn through the market, that the Financial Services Commission convened what they called an emergency market monitoring meeting. An emergency meeting to monitor the emergency that had already happened. The actionable steps that came out of it were exactly what you'd expect from a regulator arriving fashionably late. They froze new listings of single-stock leveraged ETFs. They hiked minimum margin requirements for retail brokerage accounts. And they mandated risk management training for retail traders before they could access complex derivative products. Risk training, after 1 million accounts, had already been wiped out. That is the textbook definition of closing the barn door after the horses have already burned the barn down. In both 2008 and 2026, the authorities showed up with a broom to sweep the floor only after the casino had already paid out and the damage was done. That's because regulators are almost always built to fight the last war. After 2008, they cracked down hard on mortgage underwriting standards and bank leverage, but they consistently struggle to spot the risk hiding inside whatever new financial innovation comes next. Look at the South Korean ETF market beforehand, and regulators just saw standard retail trading. They failed to model how the daily rebalancing of 3 times synthetic leverage, stacked on a highly concentrated index, would build an automated doom loop all on its own. So now we have the twisted incentives, the synthetic leverage, and the blind referees. What happens after the crash? Because the aftermath is where the real cost of this machine actually gets tallied up, and if you've only seen the film adaptation of Lal or The Big Short, you are missing a grim chunk of that reality. The movie naturally focuses on the victory of its protagonists. It's satisfying to watch Michael Burry and Steve Eisman get proven right after years of being mocked by the establishment. The climax is them cashing out on their massive bets, but who actually paid them? That's the punchline the movie leaves out. The guys who shorted the market got paid, yes, but they got paid because the government stepped in with massive taxpayer-funded bailouts to save the very banks that built the doomsday machine in the first place. The institutions that created the toxic assets, funded the subprime lenders, packaged the fraudulent collateralized debt obligations, and sold the naked credit default swaps were deemed too big to fail. If they collapsed, they'd take the global commercial paper market down with them, and businesses everywhere would struggle to even make payroll. So the taxpayer absorbed the losses. The shorts got their billions, and those billions ultimately traced back to the public purse that bailed out the counterparties on the other side of the trade. And the truly galling part, almost nobody went to prison. Not the collateralized debt obligation managers who packaged the fraudulent loans, not the rating agencies who rubber-stamped them, not the bank executives who ran the casino. The system absorbed the shock, socialized the losses, privatized the gains, and carried on exactly as before. The architecture of the machine was preserved, untouched. Now look at the fresh data out of South Korea in July 2026, and the toll takes its own uniquely brutal shape. Because as the Kospi entered freefall fueled by these ETF liquidations, the Bank of Korea took a policy action that somehow made the crisis worse. The stock market was in free fall. Retail investors were getting margin called left and right. Liquidity was drying up, and the central bank's response was to raise interest rates. In a unanimous vote, they hiked for the first time in 3.5 years, pushing the base rate up to 2.75%. Borrowing costs went up right into the teeth of a crashing market. Their justification comes down to their mandate: price stability, above all else. The Bank of Korea pointed to stubborn localized inflation and a weakening currency as the primary threats, and decided defending the won and crushing inflation mattered more than protecting the equity markets, even though the timing was catastrophic for every leveraged retail trader caught in the middle. It's the financial equivalent of pouring gasoline on a house fire. Raising interest rates raises the cost of margin debt, which means retail traders who'd borrowed money from their brokers to buy these 3 times leveraged ETFs suddenly faced higher interest payments stacked directly on top of collapsing asset prices, which accelerates the margin calls. A margin call happens when the value of the assets in your account drops below the broker's required minimum threshold. The broker demands you deposit more cash immediately, and if you can't, or the market is falling too fast to react, the broker's algorithm automatically sells your assets at market price to cover the debt. No negotiation, no grace period, just an algorithm doing exactly what it was built to do. Bringing this back to human scale and to the statistic from the opening of this episode, because the sheer volume of it is genuinely staggering. In July alone, official data and brokerage reports show forced liquidations crossed roughly 340 billion won. Over 1.2 million leveraged retail accounts in South Korea triggered margin calls, and somewhere between 320,000 and 360,000 of those accounts were forcibly liquidated by their brokers. Put that against the population. South Korea's adult population, ages 15 to 64, sits around 35.7 million people, which means roughly 1 in 30 adults in the entire country received a margin call. Not 1 in 30 active day traders, 1 in 30 adults, period, in the general population. And the demographic breakdown reveals exactly where the wound cuts deepest. Local financial reporting indicates that traders in their 20s and early 30s made up roughly 60% of the liquidated accounts. 60%. An entire generation wiped out because for 18 months the line only went up. They piled into 2 AI memory chip stocks with borrowed money. They watched influencers get rich. They heard the media call artificial intelligence the unstoppable 4th industrial revolution. And they were handed cheap margin by brokerage apps deliberately designed to look and feel like video games. It's the same cycle of financial amnesia, on repeat, every single generation. In 1999, it was the internet, and the belief was that it would change the world so completely that old-fashioned metrics like price-to-earnings ratios simply no longer applied. In 2005, it was American housing, propped up by the deeply held myth that real estate prices never fall nationwide. In 2026, it's artificial intelligence. And the genuinely tragic part is the underlying premise is usually correct. The internet did change the world. Artificial intelligence is reshaping the global economy right now. But a revolutionary technology does not suspend the laws of financial gravity. A good company is not automatically a good stock at any price, especially not when you're buying it with 3 times leverage strapped to your back. The system didn't need new villains in 2026. It just needed a fresh batch of people who weren't around for the last one, which brings up a real blind spot. One that sits inside both Lewis's book and the current coverage of South Korea. The Big Short is a genuinely compelling book, but it's told almost entirely through the eyes of the people who profited. We follow the eccentric traders, the socially awkward hedge fund managers, the loud analysts, and we root for them to beat a corrupt system. But by aligning the whole narrative with the winners, it quietly abstracts away the human suffering. It barely touches the millions of ordinary Americans who lost their homes to foreclosure, lost their pensions, lost their jobs in the Great Recession that followed. The destruction of middle-class wealth gets reduced to a backdrop, a default rate ticking up on a screen somewhere. And we're watching that same blind spot play out right now in the coverage of the Korean crash. Turn on financial news today, and the dominant storyline is entirely the scoreboard. Samsung dropping 10.7% in a single session. SK Hynix dropping 15.4%, the worst single day in its corporate history. Analysts debating whether the Kospi finds technical support at some moving average. Institutional foreign funds yanking $13.2 billion out of Korean equities in a matter of days. What you don't hear about is the ordinary 25-year-old in Seoul, whose entire life savings just got vaporized by a broker's liquidation algorithm. Someone who chased a trade that felt right up until the exact moment it wasn't, who was told artificial intelligence is the future, who was handed the leverage and took it, which highlights a real distinction worth sitting with. Being right about a financial collapse is not the same thing as being on the right side of it. Watching a bubble inflate and pop from the outside, analyzing it on a spreadsheet, is an intellectual exercise. It is very different from being the one holding the asset when the music stops. Burry and Eisman were right, mathematically. But the millions of people who lost everything, whether in Nevada in 2008 or Seoul in 2026, weren't necessarily greedy or foolish. They were the ultimate bag holders in a rigged game. The fans in the stands who never realized the casino could force them to sell their own tickets. So, pulling all of this together, we've traced the DNA of financial catastrophe all the way from Salomon Brothers in the 1980s inventing the securitized bond, through the subprime mortgage machine of 2008 to the synthetic leveraged AI ETFs in South Korea today. The machine survives. It just changes its address, updates its jargon, and finds a new asset class to commodify. The real question was never whether you, sitting at home, could have built some complex mathematical model to see the 2008 housing crash or the 2026 Korean margin call coming. The actual choice is much simpler, and paradoxically much harder to make in real life. When everyone around you is borrowing money to chase the exact same trade, when the social pressure to join the mania is overwhelming, when your neighbors are getting rich on paper and you feel like you're the one being left behind, do you trust the room or do you trust the math? Do you look around at everyone making easy money and jump in, assuming that because everyone's doing it, it must be safe? Or do you sit alone with the dense, boring documents, read the fine print about beta slippage and counterparty risk, and let your peers call you crazy right up until the day you turn out to be right? And that leaves one last structural thought worth carrying with you. If this financial machine never actually dies, if it only adapts and evolves and finds a new underlying asset to securitize and leverage, from corporate junk bonds in the 80s to mortgages in the 2000s to tech ETFs today, where is it quietly setting up shop right now, inside your own portfolio? That might be the most important question you can ask yourself. Are you holding the actual tangible asset? Or are you, without fully realizing it, holding the synthetic bet on the asset, wrapped in a layer of leverage you don't completely understand? Trust the math, not the room.